Well, good morning. Welcome to our session on investment portfolio insights from a local and global perspective. My name is Carrie Lombardo, and I am the Chief Strategic and External Affairs Officer for MERS. And with me this morning is Jeb Burns, Chief Investment Officer for MERS, and Mike Levitt, CEO of Kayne Anderson Capital Advisors. Prior to joining Kayne Anderson Capital Advisors, Mike worked with Apollo Global Management, one of the largest private equity firms in the world. And today, we'll be talking about the current state of the financial markets, changes over time in the investment industry, and the impacts of those shifts in forecasts for the future. But before we dive into that discussion, Jeb is going to give us an overview of the MERS investment portfolio and update.
Thank you, Carrie. Yes, they mic'd me up a little bit before I knew I was mic'd up. Well, welcome everybody. I hope you've had a great conference, and I hope you'll find this morning of some interest. It should be entertaining. You can just call me Bubblegum. So, it's my new nickname, and I really think it might stick. Oh my! I didn't even get that. I didn't see that coming. So the focus of my brief comments, what I'm going to do is I'm going to take you through our investment philosophy. I'm going to touch a little bit on a new asset allocation approach that the board approved this summer. It's called VBA, it's valuation-based asset allocation. I'm going to highlight some of our longer-term performance. I'll give you a snapshot of some of MERS' private assets from around the world. And then, right as we kind of head into the conversation, I'm going to talk a little bit about the financial markets and show you some slides which I think tell an interesting story about where we are today. So I believe that the most important thing is having the appropriate roles and responsibility, and really knowing what drives you. What is your ethical foundation and your philosophical foundation, because I think it helps focus how you're going to invest. Chris touched on it. We have sound governance structure, and I can tell you, having just been with my peers from around the country, we have one of the strongest and most functional governance structures in the country. And I'm not saying that because you're here. We are very lucky. It is sound, it is focused, and it makes my job much easier. Asset allocation is the most important thing that you do. Getting that risk right, getting the right mix of stocks and bonds is critical to being successful. And then, this valuation-driven approach, I think will allow us to, get higher returns over a longer period of time, and also, take advantage of the fact that we have a long-term time horizon. We're not forced sellers, so we can have an investment and we can wait 5-7 years for those higher returns to, come to fruition, and that's a benefit. So we really can take that longer term view because we're designed to be around for 10, 20, 30 years. Low cost, $11.5 billion. The fact that we came together, 73 years ago, we naturally bring economies of scale to the marketplace. My team has a reputation of being brutal negotiators.
Yes.
Right? That is true. And with that, when we go out and we invest with external managers, we can drive economies of scale. We can get a better deal, and with the resources and having a team internally, we can also manage money in-house, and those at no expense, and that goes right to our bottom line. Diversification is key. A lot of times, especially at the top of the market, everybody's like, "Why aren't you just invested all in the S&P 500?" And there will come a time, actually the last couple of days, people understood why you were not all invested in one area. So by adding a mix of stocks, bonds, and alternative assets, you're able to kind of smooth that ride, and it's an easier, softer way to get to that actuarial rate of return. And then keeping it simple. That may sound kind of trite, but investments are complex. With a team of very smart people and external advisors, if we can't wrap our arms around how an investment's working, that tells me there's complexity risk, and we should simply avoid it. And then capital preservation is paramount. It's really hard to come back from a complete loss. So we look at every investment from that perspective. What's the worst thing that can happen? And then we manage that risk accordingly. This next slide is, I think, going to show why that's important. So when I started, the bottom line goes to 2001. And what this shows is, back then, we were sending out $182 million in pension checks a year, as designed to meet the needs of our retirees. Today, it's 892. That's close to $900 million a year. Do some rough math, that's 8-ish plus % a year going out the door. The portfolio is structured in a way that we can handle that, but that means I have to pay attention to that downside. I have to make sure that we can meet our liabilities, and that does have an impact on how much risk we can take. A little bit on valuation-based allocation. Traditionally, what we did is you would do an asset allocation every 3 years or 5 years, and historically we've done about 65 stocks, 35 bonds, and then we would invest around that and try and outperform that number. The approach we're taking now is we're monitoring the portfolio in the markets on an ongoing basis, and we're only taking risk, or I should say we're increasing or decreasing our risk when we think we're going to be compensated for it. So it's really an ongoing asset allocation process, and what this does, it allows us to eliminate emotion. So I talked last summer, we took about 5% off equities, and you'll see later that helped dramatically from a relative perspective in the fourth quarter, but it also forces discipline. We're human beings and we're driven by emotion. We're actually, none of us are designed to be good investors, and when you go into a financial crisis, the last thing you want to do is go out shopping. That's actually the perfect time that you should be buying assets. This approach will allow us to then dramatically increase risk at that time. And it's also consistent with our long-term philosophy. You see the quote there, mean reversion drives long-term returns. Markets go up, markets come down. Our whole structure is designed with that in mind. We understand that, and we have disciplined team and processes in place to make sure that we can take advantage of that. So this is a chart which actually is in the board. It's actually in my quarterly report, and we share this with the board. These are the asset classes that we're monitoring on a valuation-based approach. I'll just take you through this. At the bottom, you've got the 10-year expected risk. That's the volatility, the upward and downward movement you can expect from any asset. You look in the upper right, you see emerging market equities. That right now is probably the best bang for the buck. It's also the most volatile. You go to the far left and you see cash. That's safe. You get a nice little return, but it's not going to meet your actual rate of assumption. If you look at the bottom there, and that's the forward-looking, that's what, based on where we are in the market cycle, U.S. equities are pretty much 0% for the next 10 years. Now, that does not mean that the U.S. markets are not going to be a great, wonderful place to be. But at this point in the cycle, a lot of those profits have been taken. And the expectations are other areas of the marketplace are going to be more attractive going forward. The bulk of our assets, which you'll see later, is still in the U.S., but we have reduced that exposure, and we've tipped some of it to Europe and some of it to emerging markets. We've increased those allocations. So this kind of accentuates that point. This is the 10-year outperformance, and the top line is the S&P 500, and the bottom two would be developed Europe, Japan, Australia, and then emerging markets. And you can see there the U.S. has had a wonderful, wonderful run. I think we've all benefited from that. Markets just do not go in one direction. We're a global economy, and other markets will have their day. And so this is one of the metrics we look at, and it says, we should probably start shifting assets to other parts of the globe. So here's the portfolio. If you look on the right, this is kind of our neutral position, about 55.5% equities, 18.5% fixed income, and then the remaining is in fixed income. That's where we're trying to take, we're trying to get outsized returns. It can be in private equity, real estate, farmland, those type of things. And then if you look over to the left, that's where we are today. You can see we're about 6% lower on equities. We've increased our fixed income allocation. That's simply because we feel that taking risk off is the appropriate thing. And then really in the private assets, we only invest there when we really find the opportunities. So we've got a full team. We search the globe. and we're looking for assets which people that frankly need our money. We'll talk a little bit more about that later, and also depressed assets where we can improve them and get a higher rate of return than other parts of the portfolio. So over the last 10 years, here's our calendar year performance. I think what's of note is that it never is the actuarial rate of assumption. It's dramatically higher, close, dramatically lower. It does smooth out over longer terms. Want to highlight these things. We have historically had lower risk in our portfolio, and we think that that pays off over the long run. And I'll show on the next slide, will kind of be a proof statement. And what you can see here is in the last market pullbacks, we outperformed dramatically. 2008, we outperformed by almost 200 basis points, 2%. So that's money we didn't lose, and it's much easier for us to catch up with the markets by having that downside protection built into the portfolio. A few statistics for you to just kind of understand how we structure the portfolio. You can see there, so standard deviation is just the risk in the portfolio. That's the roughly estimated upward or downward movement in any one year, because risk goes two ways. It goes up, and risk actually goes down as well. Our 10-year standard deviation is roughly 7%. The benchmark, the 65/30 global benchmark, is 8.65. And the Sharpe ratio basically it tells the tale, are you being compensated for the risk you're taking? Anything over 1% says that we are. So when we make an investment, we're actually being paid for the risk we took. So annualized performance. So how have we been doing on an annualized basis? So what this shows you, I think I'll just highlight quickly. If you go out to that 10-year mark, we're outperforming the policy benchmark. We're basically at 9%. It's pretty good. We're at the end of a bull market cycle, but those are strong returns. We're outperforming our policy benchmark, so we are adding value, active management, the decisions we're making, the managers we're hiring, we're adding value over our policy benchmark. And then if you go over to the fourth quarter of 18, that kind of highlights the fact that that was a rough quarter. Volatility was back in the marketplace. The Fed jumped in and lowered interest rates, or signaled that they would, but we dramatically outperformed the markets. So in that fourth quarter, we were down 5.56%. We outperformed just in that quarter by 285 basis points. And that's a result of taking risk off last summer as we felt the market was starting to top. So where are we at as of the second quarter of the year? We're up 8.24% through June. So growth of $10,000. Are you better off being in the active portfolio versus the policy benchmark versus the actuarial rate of assumption? And the answer to that is yes. We believe that the new valuation-based allocation approach is going to actually allow us to widen that number over the coming years. Stay tuned. I'll be back next year. So where are we invested? Again, diversification's key. It's a global marketplace, regardless of trade wars, which seem to be breaking out about everywhere. The bulk of our assets are still in North America, just under 60%. We've got a large chunk in Europe, and we've got a significant amount in Asia. A large amount of that is also in Australia, a very safe, robust market. And then I would say we've been turning our sights on the real asset side. Think farmland, think real estate to South and Central America. That's a place where people want our money, and we've got some good partners down there, and I'll show you some of those investments in a little bit. So what are our top 10 holdings? A lot of these come from our passive equity indexes. You can see here it's mixed. Our top 10 holdings between what you would expect: tech, energy, financials. But the fixed income side is what should give you some comfort. The bulk of that is in treasuries. So those are very safe, very liquid government bonds. So we've got the money to meet our liability payments, and we also have the money to make sure that we can buy assets when they're on sale, or when we can victimize people who need to sell their assets. So on that kind of, when I had that little pie chart of about 25%, which is our private markets, this is something we hold. So we've got a commercial farm in Australia that grows cotton. We bought this on sale. This was an unloved asset, and this is going to, and the reason we're making these investments is going back to that second slide, we're a mature fund. We send a lot of money out the door. We need income. These are the types of investments which we can hold as a pension fund for a long, long time, and just every year money's coming in, and then we send it to, well, not you, but we send it to our loved ones who are retired. So we own a large coffee plantation in Hawaii, and this is actually under harvest right now. It's 1,500 acres. This is very high end. This is, there's a lot of protection against recessions. This is a part of the market that, you know, very, very limited specialty niche resource, and it's very expensive. This should, we hope, return 9 to 11% annually to the portfolio, and this is something we'll hold for a very long time. We also, when I talked about South America, we're invested in a large farm in Peru. They produce table grapes, organic blueberries, which are very tasty, asparagus, and then avocados. So if anybody in here ever goes to Sam's Club or Costco and you buy a little crate of avocados, you bought your own avocados. So I was actually in the plant, and I'm like, where are these going? And they're like, Sam's Club and Costco. We have a very, very experienced partner here, and this is quadrupled in value. So now this is one I'd like to say we're going to hold this for a long time, but there's a pretty good chance we're going to sell it to somebody. So, well, we also invest, what we try to do is get a tailwind, you know, where the market's going to support an investment. So we're all getting older. You know, medical technology is a good place to be. What this is simply is it allows a doctor in the office, rather than going out for an expensive MRI, they can simply scope you. So there's a little, basically, camera in your knee, shoulder, or elbow, and they can see if it's damaged. And then it's fully disposable. It's much cheaper, and this is the type of thing that we look for, and this is a direct investment that we made in this company. So, real estate, we said the U.S. we recovered first from the global financial crisis, and it's a more attractive place to be for the last 10 years. Europe was a little behind us, and so we've shifted our attention here, and so we're investing in real estate. We invested in 2 funds recently. You know, a lot of the assets are in Spain, actually. So a little bit onto the markets before we begin our conversation. We are in the longest recovery since World War II, 120 months. Now you can see on the right that little bubble, a little green thing, 2.3%. So the growth has been a little bit slower, but we are still pretty long in the cycle. So now, could we go a year, 2, 3? Definitely, and that would be great. But this gives me pause. So it's just one of the things we look at. There'll be a test on this later. Very complicated, but essentially what this shows is the gray lines are recessions, and the blue line would be the yield curve. And what this simply means is when a yield curve inverts, it means the money you get from short-term bonds under 2 years of maturity, so think about your checking account, versus a 10-year bond. You get paid more for the short end. What that signals is the market's more concerned about the future than they are the present. So that says that there's elevated risk and elevated concern in the marketplace, and it's slightly inverted this year. So this is not 100% predictor of a recession, but it's definitely one of the things that we take a look at. And when you look at the length of the recovery, and you also look at the valuations that they showed in that earlier slide of the U.S. versus other areas, it says that we're definitely, I don't even think it's the 9th inning, but we're in, but it's baseball. It could go 13 innings. This is critical to understanding kind of the challenges that all investors globally, and Michael can speak to this as well, that we're under. This just shows the Fed rate versus U.S. Treasuries. Again, government bonds. This is actually staggering when you take a look at it. So the Fed rate in 1980 was 20%. That's the interest rate they were charging banks. You look in 1984, you could go get a CD, and I remember this, for 14%. You can earn 14% for just putting your money in the bank, essentially. Today the Fed rate's 2%. The 10-year Treasury's at 150. And when you think of building a portfolio, you have to have a certain, we've reduced our fixed income exposure, you just have to have a certain amount. Traditionally, you might have 40% in bonds. Well, that's earning 1.5%, let's just say 2 to be friendly. You put 4% on top of it for equities. Well, now you've got 6 and 2. Okay, well that's not 8. Now, okay, we'll have to do some alternative investments, and you can see the challenges we're under. Now, I believe pretty passionately there's some demographic tailwinds. People are getting older, they got to spend money, that are going to they're going to increase inflationary pressures. Interest rates were going up for most of the year in the U.S., and frankly, nobody got it right. They went down again. Long term, I think they'll go up. When that happens, that will push all returns up, but lower interest rates create a very challenging investment environment for really everybody. So, in conclusion, MERS has a disciplined value investment philosophy which is shown to outperform over longer time periods. Patience will be really important, and discipline, especially with an overvalued U.S. market. And then low interest rates are going to result in a difficult investment environment going forward.
Well, thank you for that update. And Mike, thank you for joining us this morning.
Pleasure.
Would you tell us a little bit about your background?
Well, so about a third to half of the room will be pleased to know I graduated from the University of Michigan. Go Blue, 1980. Had I really thought about the crowd, I would have worn my maize and blue game socks. I apologize, I did not. So I've been in the investment business markets for now 36 years. Most recently, as you point out, took over as the CEO of Kayne Anderson. We're a diversified investment firm, and in the sense we invest in real estate, energy, debt, and growth capital. Prior to that time, I was the vice chairman of Apollo Global, large global investment firm. I ended up as vice chairman of Apollo because about 20 years ago, I started my own investment firm and was very fortunate and grew that to about $50 billion in assets under management. That was based in New York, but I met a woman about 12 years ago who lived in Los Angeles. To make a long story very short, I sold my company, moved to LA, and have 2 little kids. So you saw who won the decision as to where we were going to live on that basis. But I've been investing in both debt and private equity now for really decades. First company I ever bought will be familiar to many of you. Under the theory of invest in what you know, I bought Chef Boyardee. And since I knew it well, that was probably 2.5 decades ago. Pleased to be here. I do have to say, Jeb, I travel the world speaking to institutional investors, and I got to tell you, 9% over the last 10 years is actually impressive and way better than I thought you had done. So kudos to you.
Yeah, the mix of the panel, obviously I lost control of that.
Yeah, thanks for the invite, Kerry.
Yeah. Mike, Jeb talked about how U.S. equities are overpriced and how we've shifted allocations from the U.S. to international equities. Now, comparing U.S. performance over the short and long-term horizons, could you tell us your views on the global markets?
That's a really technical question. First of all, embedded in that question, one of the things that Jeb mentioned is very active management. And the markets have become such that just about the only way to get good performance or outperformance is to be very active and to be very thoughtful about what is going on in the markets year to year, quarter to quarter, and over the near and long-term horizons. Very clearly, and as demonstrated by Jeb's charts, the U.S. equity markets have had a tremendous run. Right? And they've had a tremendous run for any number of reasons, including that the U.S. is more and more viewed as the place to put capital globally. Included would also be that rates have been so low for so long. Right? We've got to remember, going back to what is known as the GFC when I travel overseas, which is stands for global financial crisis, is how the 2008-2009 mortgage crisis is referred to outside the U.S. as the GFC. Central banks globally have really intervened or weighed into making sure that markets and economies perform, and held rates, one would argue, artificially low for now 10 going on 11 years. And that has had implications for the U.S. markets, as you're forced to invest in, quote, riskier assets, i.e. stocks, et cetera. That can only go on for so long. And again, Jeb's charts, I think, nicely pointed out that there is both risk in terms of future performance in equities, and I think it's significant risk, and I think that that chart that you showed, Jeb, that showed stock market projected returns over the next 10 years being sub 5%, close to zero, is probably very accurate when you look forward. And by the way, there are decades when that happens, one of which would have been the 10 years preceding this most recent 10 years. If you had gone to sleep in 1999 and woken up in 2009, you would have thought nothing happened. The stock market was flat for that entire 10-year period. So we do have those kind of markets. So I think that increasing allocation to private assets, as your target shows, being very thoughtful about fixed income, looking abroad to markets that have perhaps more opportunity, and being very cautious on where you are in U.S. markets makes a lot of sense, especially given your particular income outflow needs to fund the pension obligations that you have.
So you mentioned, investing in private assets, and that diversification and that opportunity still exists. Jeb, what are you looking for when you're evaluating private investment?
So when we were prepping last night, because Carrie likes to prep, so we were talking, well, you knew I was going to do that. So seriously, what we look for, and this sounds, a little flippant, but it's like we're looking for people that need our money. So, and Mike and I were talking too. It's like, if your fund is oversubscribed, you've got a line out the door that people would give you money, and I say, well, that's great, but I'd like a discount. He's going to say, well, I know you'd like a discount, but you're not going to get one. So that's what we look for. So, because when our capital is needed, there's a couple things. We can negotiate, frankly, a better fee arrangement. Frankly, we can be higher up. We can be a true partner and participate in that upside. So just, that's really the first place we look. Then we look for things that have a tailwind. There's risks in everything, but medical technology. People are getting older. Our look at agriculture. The food. We're $7 billion going to $9 billion. That makes sense. Where are there pockets in the marketplace where they're poised for, where people misunderstand the risk, where they perceive more risk is there than there actually is, and that is something that's critical. Those are kind of the 30,000-foot view of the things we look at. And then I think lastly, we do care about income. We do. So that's why, especially in the private side, we'll have a bias towards finding things that do produce income for the fund. But also, for the most part, in that big private bucket, the idea is it's supposed to beat the rest of the portfolio. If we're going to lock up our capital, locking up our capital means basically that when I call them, I can't get it. I have to wait 7, plus years. We want to get a premium for that. Otherwise, it's simply just not worth doing.
Yeah, the private assets are often, call it, misunderstood in the sense that they're not necessarily risk assets, right? An institutional investor, such as, if you will, the aggregated funds of MERS that Jeb and the team are overseeing, has access to private funds, private markets that individuals don't, frankly. I mean, I don't really go around the world talking to individuals. I go around the world talking to large aggregated pools of capital, which are generally pension funds, right? As we were talking last night, I said, look, on a global basis, I work for policemen, firemen, teachers, road workers. That's who I work for. From Helsinki to Melbourne, literally, and including in Michigan. And that those aggregated pools can access private assets. And private funds, what we really try to do is we're not trying to bring riskier investments. But what Jeb is really trading on is his ability, first of all, doesn't need to be able to sell the investment in the fund tomorrow, i.e. illiquidity. Jeb can say to someone like me, like, look, Mike, that's a great idea, but I'll say, but I can't give you your money back for 7 years. That said, I think I'm going to make you 15% a year, so in 7 years I'm going to give you 3 times your money back. Well, an aggregated institution like MERS can do that, right? So you're trading on illiquidity. The second thing that you're taking advantage of is complexity, right? Jeb and the team can absolutely drill me and my teams on complex investments, not necessarily riskier, but complex. Some of the investments that we make in clean energy, in senior living, it's complex to execute, but Jeb and his team can do that due diligence, right? So you're getting paid, if you will, you can get extra return for diving into and doing the work in complexity. Those are private markets, right? So it's important to understand that what we try to do in these private funds is it's either illiquidity, we need the money for longer, or it's complexity, specialization, right? To Jeb's point about guys like me needing your money, right? I don't want to have to tell the story to a whole lot of folks. I want to be efficient about the fundraise because, right, what we do every day is we invest. We actually don't market or sell our funds every day. That's not what we're built to do. So what Jeb does and Jeb's team is they form, call it partnership kind of dialogues with people like me, so that when I get a good idea, it may be complex, it may be very specialized, but it creates excess return without, in fact, incurring excess risk. And then the partnership is, I call Jeb, say, listen, we've got a really good idea, we really like this. They absolutely grill us on, well, why is this really a good idea and why are you sure we're gonna get these returns? But utilizing that sense of partnership, utilizing the ability that his team and he have to due diligence these things is what enables, and the aggregation of your capital is what enables you to access these excess returns, right? Because what you really want is you want more return for less risk. That's what you really want.
And actually, your point there, just to get a little bit under the hood on how we actually manage the portfolio and relationships. What we'll do is if we find somebody that we trust and we've made that fund investment, well, underneath that fund there might be 15 companies. So on the private side, we'll seek co-investment opportunities. We own 27% of a mine that just launched in Chihuahua, Mexico. Mines silver and zinc. That came out of a fund investment that invests in mines all around the world. My team started kind of doing some underwriting underneath it. We have a trusted partner, and the other thing Michael talked about is we're looking for people, first off, that have a passion. They love what they do, both on the liquid side, in stocks and bonds, but also on the private side, and that they have expertise. That's what's key, because we're like a puddle. We know a little bit about a whole lot of things, but we're also pretty good at finding out who really does know a lot about something, and that's what we'll dive into. And once you've got that relationship, that leads to other investments, and frankly, sometimes they have capacity issues, and we're the first people that get a call.
Thanks. So the two of you combined have over 50 years of experience, maybe a little more, working in the financial markets. How has the business changed even in the last decade? What opportunities do you see?
I'll just jump from my side of the desk. In the last couple things that I've seen a lot of consolidation. So I've seen a lot of firms, both on the public side and private side, getting bigger. I mean, one thing from the global financial crisis, there's fewer banks and they're bigger. Ironically, we're actually not safer. I've also seen a dramatic increase in passive investing, indexing, which, I think that's provided a lot of opportunities. I think there's also been a democratization of the marketplace. So it's much more easy think about ETFs, right? Mutual funds. People in this room, all of us can access parts of the market that 10 years ago, nobody, even we couldn't. We would have to go through an intermediary. Computing power. The work that we can do in my office, 15 years ago, you'd have to be some specialty hedge fund in New York City with computers, huge computers. What we can do on our phones right now, the world really has changed. So we manage, and I think the insourcing, we manage 30+% of the assets in-house. We can do all our own research. What my small team can do, we simply, people needed a full firm to do a decade ago. So we can now decide, I want to access this part of the market. We can do it very, very cheaply. So that's kind of, so the landscape's changed. I think from my side, we're really more pure, we're asset managers in the real sense of the word, not just asset allocators. And that's a big change.
Yeah, I think underpinning all that, right, is called information and access. 36 years ago, you could find plenty of opportunities, even in the stock market, where there was information asymmetry, or where you might have knowledge about something and I didn't. It's virtually impossible today to find a situation in traded markets where everybody who wants the information can't have it. Everybody gets it. Everybody can have it. Michael Bloomberg got rich, really rich, because...
Super rich.
Super rich. Run for president rich. He got, because he created a screen that sits on, anybody can have it, sits on your desk. You can have it on your iPad if you want. Provides all the information you could ever need.
It's actually on my phone.
Right. All the information you could ever want. And so, interestingly, that creates a situation where Jeb is right. There are many, call it asset classes, where Jeb and his team can invest just as well as my teams could if I chose to be in them, or better perhaps, because information is available, right? So that's on the one hand. Access to investing has also, to investing in these private markets or private funds we talked about, has also gotten much greater, and that business has grown tremendously. I don't know that I could name 10 alternative investment firms that were around 36 years ago when I started in the business. And now there are, God knows how many. But so information, access to being able to invest, Jeb and his team, if these guys say we want to invest in Europe, real estate in Spain, you can find a manager to invest in real estate in Spain, right? I want to have a cotton farm in Australia. You can get to a cotton. It's actually astounding, because 36 years ago there is no way that all of that would have been accessible. So it's the access to the information. The third point I would make about that is that the kinds of things that you can invest in have also just, expanded tremendously over that period of time. And that's something that's important to always remember about investing, is that the world and markets and opportunities evolve. And it gets back to this active management and being aware of where are the opportunities going to be. It's, I forget how Wayne Gretzky put it. Why he was so good is because he always tried to go to where he thinks the puck is going to be. And to some extent, the investment challenge is some of that, trying to get to where you think the opportunities are going to be. But the ability to do that and to access those opportunities, I think, is much, much greater. But you've got to be aware of what's going on. I mentioned that the first company I ever bought was Chef Boyardee canned pasta, right? Well, the last investment conversation I had before I showed up here in Traverse City was I was in a meeting discussing utility grade solar energy projects, actually in Michigan. I mean, you know, from Chef Boyardee to commercial scale solar, from an investing point of view, is a big difference. But you gotta understand where things are going.
You know, two last things. You know, we talked about this a little bit last night. Is the competition for assets is dramatically increased. So there are groups, believe it or not, just like this, municipal pension plans around the world. You think about Asia, you think about the emerging markets, they have sovereign wealth funds. These are basically just, you know, countries are saving to make, you know, economic development, you know, possible in their country in 10, 20 years. There are insurance companies. There are social security systems. There are defined contribution systems being run by institutions all around the world now that they weren't in the Middle East, you know.
Right.
Those people, you know, 10, 15 years, 20 years ago, they weren't even around, and now they basically have teams just like us, and they're all searching for the exact same investments. So the field's much more crowded than it used to be. So it's finding these good assets is harder. And then just lastly, the thing that's changed is in our large cap portfolio, it's all passive. You know, you used to have large cap, small cap, mid cap, and we just, you know, given the fees that we have to pay, we moved away from that. So we manage all that money in-house ourselves, and that would not be a growth business.
And by the way, I would say most of the more sophisticated institutions that I speak with globally are moving to or have moved to passively managing their big equity portfolios or equity exposure, because you're right, you can design whatever you would like. You can be S&P 500, you can be some of Europe, you can be some of Asia, et cetera. It makes a lot of sense. And to Jeb's, and Jeb's right, the access is not only can Jeb get to any asset class he wants to, but it is true. As I mentioned, I travel globally, and I'm very fortunate in our investor base literally stretches from Finland to Australia and everything in between. In the last 2 weeks, I've been in Asia, Scandinavia, Europe, New York, Chicago, and Traverse City. And investors in all of those locations, in all of them. And they all have access to everything. And that's why some of these characteristics that Jeb talked about earlier, about the partnering, about these really, really working hard to seek out special opportunities, I mean, you have to, in order to get good investment returns and good performance, because it's astoundingly competitive. I mean, I never dreamed that in my lifetime I'd have, you know, a half a dozen investors from Helsinki, of all places. I never dreamed I'd ever go there, let alone have to go there twice a year. So, big difference.
Jeb, Mike mentioned solar energy. So that made me think of the pressures that I've been reading about with environmental and social governance investing. How does your team address the ESG movement?
Well, Carrie, we're well known for loving the planet and loving people, yeah, and we do. Our number one priority is to get the highest return for our invested capital. So we have a fiduciary obligation that trumps everything. So I can't make an investment, you know, a socially responsible investment, if it's not going to earn the highest return. I simply can't. It would be a breach of my fiduciary duty. That said, I pay very close attention to, and have for a long time, because these pressures are real. There are political pressures, there are cultural pressures, and there are generational pressures supporting clean energy. The divestment movement, championed by many people who go to rallies in cars demanding that we divest from fossil fuels, is very real. That was a little sarcastic. But also the environmental pressures are real. You know, I've been to India and I've been to China, and it is staggering, the pollution. I mean, it is, you know, it's tragic, actually, is what it is. So I think there's going to be pressure really in coming everywhere to find cleaner solutions. So that said, I'm looking for those opportunities because not only do I think I can drive returns for the portfolio, but I think it's the right thing to do. So, and I want to give you an example of how this actually manifests itself in the portfolio. A lot of the universities' endowments have, because they realize they can't divest from energy, totally. They just, doesn't make sense because we're going to be on fossil fuels for 10, 20 years at minimum. But they've thrown coal completely under the bus. That's their first thing they do, say, we're going to divest from coal, we will not invest in coal. Now, I've had people come to me with coal funds. I wouldn't touch one with a 10-foot pole. What you're going to end up with is what they call a stranded asset. Right now, you got a nice return, looks like it's a great investment, and you find 10 years later, your plant's being shut down, regulations making it more expensive, you're not making any money, and now I can't sell it. So whatever your political persuasion, you have to pay attention to this. It's real.
Yeah, I would, I guess a couple of points to make. You mentioned university endowments. I have served on the University of Michigan's investment board for the endowment for going on 20 years now.
Is that a good school?
It's a fabulous school for those that weren't able to go there. No, so and the endowments do feel, you know, probably the pressure, so to speak, because we've got the students saying you should divest of this, you should divest of that, and so there is that pressure. I think you're 100% right that our job and our obligation is to earn the returns for our members, our constituents, for the university in our case. And market forces over the course of time will in fact define where there are investable opportunities. As it relates specifically to ESG, which is environmental, social, and governmental, you know, we are one of the 1,000 or so investment firms that are signatories to what's called the United Nations Principles for Responsible Investing. And the fact is, like, I have to be, because globally, every meeting I go to, I'm asked the question, you know, are we in fact ESG positive, compliant, in agreement? So it is a real force. Interestingly enough, also every meeting I go to, I seem to be asked, do I have a fund that is doing anything that is sustainable, clean, or impact? And I was in Scandinavia about 2 weeks ago, meeting with investors about our fund that lends money to companies in the United States. Okay? That was it. That's why I was there. Every meeting, every single meeting, you know, just one more thing. Do you have a clean energy fund? Do you have a sustainable fund? Literally. So which also, what that has done, right, is, and it gets to this, you know, you talked about rightly that there is so much capital around the globe that is trying to compete with what you're trying to do. What it's done, in truth, is it's probably driven not 100%, but some significant portion of the impact or sustainable funds. It's driven returns down to levels that are not, in fact, appropriate for the risk being taken. I was asked to do the keynote speech for a large global pension conference a little bit ago, and I was asked to talk about energy at the time. And I got a question, and the question was, do I think that the returns investing in traditional energy, say natural gas transmission or something, traditional energy are equivalent to the returns in sustainable? And I said, absolutely, you should be able to get mid-teens returns from both. The only problem is that in traditional energy, it's real income, by and large, in sustainable energy right now, it's about 7% real income and about 7% psychic income. And none of your members can spend psychic income. So the challenge is to find those investments, as you point out, where in fact the returns are consistent and competitive to the other investment opportunities. And they do exist in sustainable businesses. I mean, they really do exist. I mean, but they're limited, right? They're limited. We invest in utility scale solar projects, but I can't invest more than a few $100 million a year to generate good return levels. Somebody says, here's $5 billion, I can't put it to work, which also gets to Jeb's point about the good opportunities are limited, and so you want to get in on those. You want to have the relationships to get in on those.
And our sizing that is good for that, because we're not too big. I mean, we're $11 billion, so we can get a piece of this. And we actually we're looking at several solar projects right now, because there actually are around the world. I mean, Michael's got a solar fund.
Yeah.
There are grown-up, real solar, utilities essentially producing energy that you can buy into.
Oh, yeah.
And give you an income stream. The key thing is we've looked at some, but they're bid up.
That's
So
the
they're
problem
just-
is they're too bid.
You're too expensive,
bid,
and
yeah.
then so where you were hoping to get that teen return, the reality is you're essentially buying a utility, but there's greater risk, and then, frankly, you can find something in the U.S. that's safer and it's home.
But
So-
it is, look, somewhere north of $8.5 trillion is going to be invested over the next 30 years in clean energy alone, okay? Developing clean energy technologies. What that means is there will be opportunities to make real returns in and around that business. You just got to figure out where it is. And I think coal, to Jeb's point, coal's going to go away. Natural gas is going to fill that in, right? Hydrocarbons, petrochemicals are not going away. I mean, we're still going to drill for them. We're still going to frack. It's going to, for a long, long, long time. But that said, a lot of our energy will be cleaner energy over the course of the next 30 to 40 years. We are not going to be all driving electric cars in the next 10 years. Not happening. It's just not happening.
And just quickly, just on the governance side, that matters. Good, I talked about how we have a really good governance structure. I think it allows us to, be transparent, and run an efficient operation and really focus on, making sure that we have proper administrative, procedures and also investments. But global, when we invest outside the country, companies in emerging markets that have better, governance have higher returns. So these are things that are being pushed, societally and from a regulatory standpoint. But it's good business.
So we've been talking about institutional investing. What should we know as individual investors managing our own individual accounts?
Oh, Carrie, that's a very good question. I'm not allowed to give individual advice. I think Chris would look at me sideways and be mad. But what I can say is what we've talked about here is, for me personally, a diversified portfolio is a great place to start. I believe that passionately. All my money, all my deferred comp goes into the fund. But I think diversification is the only free lunch. But we have products which can help you. So this is a little bit of our commercial, but I think it's something I believe in. So we have our retirement strategies, target date funds, where you can invest cheaply, what we've talked about, essentially for the most part in index funds, which are very cost effective. They, if you're younger, they have a very much higher equity allocation, but they're diversified. And then as you get older, they rebalance for you. So I think that's a good place to start. We have risk-based portfolios as well. Where depending, if you're very conservative, you can have a lower risk allocation. But I think the most important thing, and actually I'm going to break what I said, I'm going to give advice. The most important thing is to save consistently and often. It seems counterintuitive, but you save your way into retirement. You start young, you take as much out as you possibly can, and you put that money away If you're lucky enough, like many of us here, to have a defined benefit portfolio, that's great, but you should have a 457 portfolio as well, and you should save. We're living longer, and I think you can tell I'm a bit of a saver. So,
I might actually be licensed to give advice. I'm not sure, but a couple of points. The Australian pension system is generally considered among the best and most sophisticated in the world. And in Australia, employers actually are required to contribute 9.5% of an employee's income every year. It's not like Social Security. It's literally 9.5% every year. Has to be put into, and then the funds are very professionally managed by folks like Jeb and his team, if you will. So Australia is actually, despite the fact there's less than 30 million people, it's the fourth largest pension system in the world, which would be why I spend time there, because they give me money, I invest it, and then I return it to them with a profit. But so to Jeb's point, one, let me tell you, you put away 9.5% a year, methodically, programmatically. When you're ready to retire, you actually are able to maintain your lifestyle. So the programmatic, start doing it when you're young, encourage your folks to start doing it when they're young, is extraordinarily important. Second thing I would say, and I guess this is a bit of an endorsement of what you all do with pooled assets, it's virtually impossible for an individual investor to beat a sophisticated institutional investor. And it partly has to do with the fact that, as we discussed earlier, individuals can't really access a lot of the investment opportunities that pooled funds such as you have. As I said earlier, we don't take individual investors into our funds, really. We only take aggregated pools. Unless an individual investor happens to be investing, a $25 million minimum personally or something like that, I suppose. And so, which is not a lot of the universe I know, at least. And so access to those investment opportunities that have higher return without really higher risk, it's only your pooled capital. Individuals just can't get at that stuff. And by the way, that's high net worth as well as middle income. I joke, I have friends who are in Goldman Sachs's funds, and I just laugh at them. Because the only thing that's guaranteed is that my high net worth friends that are in Goldman's funds are going to get overcharged and have underperformance. Those are the only two consistencies that they're going to find. Because if somebody like me is running through Goldman's funds, it's because I can't raise them from sophisticated investors like Jeb and his team, right? So I don't offer product to Goldman. And so individuals should programmatically save and find that institutional affiliate that you can access that can generate 9% annualized over the last decade, which I said are tremendously strong returns. And I see globally what folks do, right? That's what individuals should do. And sure, if for fun you want to make an investment in some stocks, have a little bit of your Schwab account where I don't think they even charge you for trades now, and because you want to buy companies that because you want to buy Apple because you buy the iPhone, or you want to buy Shake Shack because you like their burgers, or whatever it is. That's fine, but having access to a program like you all have, I think, is the right way to be investing in the markets. To be very clear, I only invest in funds, and if you will, in an institutional way. I don't try to pick stocks. I personally, I own no stock. Well, I'm forced to own Apollo because I sold them my company, which is fine, but otherwise, I don't own public stocks. Actually, the only other public stock, which number 10 on your list was B. Riley, which is amusing. I was once upon a time on the board of the predecessor company, so I have some B. Riley stock, which that would be my advice on an individual or personal level.
Thank you.
So we're running out of time. So the final burning question on everyone's mind is, when will the next recession hit?
Carrie, that's an excellent question that Michael should answer.
So I'd like to qualify this by saying I did not study economics at the University of Michigan, and so I'm not qualified to answer that question. The fact of the matter is, Jeb pointed out a lot of the, call it statistics, or the indicators of a recession. The other things to think about are that having maintained low interest rates for a long time, right? Our governments around the world, and our government has two levers to deal with the economy. One is rates, and the other is spending. Well, if rates are already low, and they've been low for a long time, you're kind of out of bullets on rates, right? Is one. The second aspect is that there are inflationary pressures that are occurring in our economy and globally, right? Housing prices, housing stock tight, employment reasonably tight. Those tend to be indicators. Third is manufacturing indices have not been great of late, not been what one would hope they would be. And so there are certainly signs, if you will, that we're in a precarious position. You overlay with that tariffs and trade wars, which just makes goods more expensive in the United States. And then overlay on that what is tremendous geopolitical risk, right? It's hard to remember a time when there's been this much geopolitical risk. You don't know, where the fire is going to start. And so, yeah, I agree with Jeb. We're in extra innings, right? And the thing about extra innings is, a guy gets up, he hits a home run, and it's over, right? An event occurs, something happens, and it's over. And so, again, not being an economist, being a guy who's invested in debt for decades, so I'm also very conservative from my outlook point of view, I would be very cautious, and I'd also be very surprised if we don't have a significant slowing in this country from, we're running about 2.5% or so growth now, down, if that doesn't happen within the next 2 years or so. It would be very surprising. We need a breather. We need a breather, economically speaking.
Do you have anything to add, Jeb?
I think you stated it pretty well. I do think you don't, the one point is you don't know what the thing is going to be. Like, everyone knows things are kind of expensive. You kind of know, you're like, well, things are going pretty well. They don't go well forever. So you don't know what that emotional thing that makes people suddenly say, I'm taking profits off the table. And when that happens, everybody starts pulling their money, and suddenly trust breaks down, and it gets restored rather quickly, but you don't know what that's going to be. So I think that's why always being prudent, always kind of really having a good handle on the level of risk you've got and having a resilient portfolio that can withstand that and then bounce back, which is what we've always strove to do, I think will help us get through this.
All right. Well, thank you both so much for sharing
you,
your
Carrie.
insights.
Thank you, Carrie.
Thank you.
Appreciate it.